My name is Evan Phoenix, and I am a 26-year-old real estate agent and investor that owns just over $1.2 million of real estate. Over the years, I've learned a ton about how to buy properties the right way, but I learned even more about how to buy properties the wrong way. And a lot of these lessons that I've learned the hard way apply both to being a homeowner and an investor. So with my experience, I thought it would be very valuable to share the 5 things that I wish I knew before owning real estate. And if I would have known these things, it would have saved me a ton of time and a ton of money. The very first thing that I wish I knew before owning real estate is the true cost of home ownership. Now, this may come to a shock to you, but the expenses do not stop after you purchase real estate. During the buying phase, you really only have 3 costs associated with home ownership that are the down payment and the closing costs, which will vary on the loan product you use and how much the bank or mortgage lender will require you to put down, the home inspections that you decide to do on your property, which once again, this will vary, and the appraisal, which will typically be between $500 and $1,000 depending on the size of the property. Now, when you purchase the property and you move in, you'll obviously have your fixed expenses like your principal, interest, taxes, insurance, utilities, HOA if you have them. But you will also have expenses that you should account for, such as needing a new roof whenever your roof goes out, a water heater, mechanics of the property, all the appliances, and all of things that have a lifespan on your property. You will want to account for them and start saving so that when that big expense comes up, you will be ready and you have a chunk of change to put towards it. The real question is, how do I know how much to save for these large expenses such as a roof? What you do is figure out an estimated cost and plug them into this formula I'm about to give you. For example, let's say that the roof costs about $25,000 and it's going to last you roughly 25 years. What you'll do is plug them into this formula. You'll take the cost and you will divide that by how many years. So in this instance, 25,000 divided by 25 years equals $1,000. Then from there, you will take that $1,000 and you will divide it by 12 months. And you should end up getting $84, which means that you should be saving $84 every single month for when that roof expense does come up. You will have the full amount for it and you'll be able to pay for it in full. Do that for all of your large expenses and then add them up and you will come up with a number that you should be saving towards every single month. This next one is one of my favorite negotiating tactics, which allows you to put less money down when purchasing a property in order to either save that money or put it towards repairs. This is the seller contribution tactic. Not a lot of people understand that when you purchase real estate, you will have to put down money for the down payment and the closing costs. What I have found is that closing costs are misunderstood to newer buyers, and newer buyers typically don't understand that closing costs are totally separate from the down payment. The seller contribution tactic will allow you to eliminate some or all of your closing costs, which consists of your recordation and transfer taxes, loan origination fees, your appraisal fees, title insurance, prepaid expenses, and more. The idea is that when you're going to purchase a property for $300,000, let's say with a 10% down payment and closing costs of $12,000, you could offer $300,000 with 10% seller contribution, meaning the seller is going to pay down your closing costs for you. And this would allow you to only have to put down $32,000 instead of having to put down the $42,000 if you would have had to pay your full closing cost amount. Now, I will say this will decrease the strength of your offer, but there's a way to get around that. Even if you were to offer $310,000 with $10,000 of seller contribution and a 10% down payment, you would only have to put down $33,000, and that would make the bottom line to the seller still $300,000, which is what they're asking for. So although you're essentially paying $10,000 more for the property, you're still putting less money down. The best thing about the seller contribution tactic is that it works hand in hand with the next thing I'm going to be talking about. Whether it's myself or my clients, I highly suggest you get a property inspection on any property you purchase. Even if you go into purchasing a property that is as is, you can still get a home inspection for your personal information. Having a licensed home inspector walk the property, look at the mechanics, the structure, the integrity of the home, you can feel fully confident that you will know all of the property's defects before purchasing the property. Now, these inspections typically cost you anywhere from $300 and $800 depending on the size of the property, but they will ultimately save you thousands and thousands of dollars. Take this property for instance. When we purchased this property, we ended up getting a home inspection, and during that inspection, we found roughly $5,000 of repairs that needed to be done, or else we weren't going to move forward with the purchase. The seller agreed to make those repairs, and with our initial investment of only a $600 home inspection fee, we were able to save $5,000 if we didn't catch those mistakes. And then after we moved into the property, we would have had to pay that money in order to fix those major concerns. So the moral of the story is get a home inspection. But like I mentioned earlier, you can use the seller contribution tactic and a property inspection strategically together in a real estate transaction, and this is how you do it. After you get back the property inspection report, go over it, make a list of the things that you want the seller to fix and major concerns that are brought up to you. Tell the seller that you want them to fix all of these repairs, or you will take a seller contribution for the amount that it would take in order to fix those items. More times than not, it's easier for the seller to go ahead and just give a credit than having to hire out contractors, manage them, make sure they get the work done, and have them inside of their house while they're still living there. So more times than not, they'll end up giving you the seller contribution. And what you can do with this, if you are handy, you can go buy the materials, do the work yourself, and save money on it. Or what you can do is go buy the materials and hire out the labor separately, and that way you could also bring the cost down so that you're pocketing a little bit extra money on top of getting all of those repairs finished. Now this next one is extremely important. Do not, and I mean do not, overpay for your property. When you are purchasing a property, lenders will typically give you the max amount that they're approving you for and saying that you can purchase. This will give you a false representation because a professional looked at all of your finances and said that you can comfortably go up to the max amount that they are willing to lend to you. Although you got approved for your maximum amount and you can potentially go and purchase a house for the maximum amount, in majority of cases, you should not do this. Let me explain how you should go about it. Now, lenders will factor in your gross income, which is pre-tax income. So already off the bat, you're getting a chunk taken away for taxes. The first thing you need to do is figure out how much money you're bringing in after taxes every single month and how much money is going out, your debts that you have, and everything that you're paying for, your expenses. You have to make a list of that as well. Since you gave all of your information to the lender, they will be able to tell you how much you're bringing in and how much you spend every single month. And they will also be able to give you your debt to income ratio. This is why it's so important to have a budget, know what you're spending money on, because you end up going out. You want to have that quality of life to where you can do things you enjoy. So with that needs to have a dollar amount so you know how much you're spending every single month. Creating a budget for yourself, you can correctly estimate your expenses so you know how much money you're going to be bringing in after everything's said and done. And based off of that, you will be able to make a clear decision on what your monthly payment on your house should be, and that it shouldn't be the maximum amount that you're actually approved for. And please do not take this lightly, because the last thing you want to be is house poor, especially in today's age where inflation is going crazy and it's so expensive to do anything. Now, leading into number 5, which could arguably be the most important, which is when you purchase real estate, have an exit plan. And this is whether you're buying a primary residence or an investment property. A lot of people these days leave it up to chance. They purchase houses just based off their looks and based off of being able to show other people that they have a really nice house. Whereas if you were strategic with it, you could have a really nice house and have an exit strategy so you know in case of any type of emergency, or if you're looking to grow your wealth and make a good investment, there are certain things that you can do before purchasing to make sure that you will get a good return on your investment. And those things include buying at the right location. If you buy in the path of progress or in a great neighborhood with great school districts, you can assure yourself that when you go to sell, you will be able to sell it quickly and sell it probably for a higher amount, since appreciation comes into play and it's a really nice neighborhood. Finding a home that your mortgage would be less than the average rent in the area is another great way to purchase a property, because let's say in a couple years you get a job promotion, you're making really good money and you're ready for a bigger house. You can go and purchase that bigger house and rent out the house you were living in, knowing that the mortgage is less than what the rent can go for, and you can earn passive income and cash flow every single month. And the last thing is not buying at the height of the market. And I know this is extremely hard to estimate, but there are certain ways that you can tell if you're buying a property for maybe too much money. The first thing you can do is have your realtor send you like-kind properties in the area that have recently sold so that you can tell if it's selling for the right amount. Also, if it turns into a bidding war and there are a lot of offers on the property that are going over asking, they ask for your highest and best, it may be best to back off and find a different property because you may be overpaying for the property. Now that you know these 5 things, you will definitely want to know which is better to purchase or rent out a property right now based on your specific financial situation, which is why you should watch this video next. Happy investing.